Hi everyone, welcome to this session of the Tiger Academy. 5 important practical points for US stocks. We're moving on from investment basics to US stocks investing. In this lesson, I'll show you the 5 important things you need to know about trading stocks in the US. Number 1, ticker symbols for US stocks. Did you know that the code system for each of the stock markets in the US is different and that company codes are generally formulated by the listed company itself? Using 2, 3, 4, or 5 letters, depending on the exchange, a company tries to create a stock code that will give it strong identification in the market. For example, the ticker symbol for Coca-Cola is KO, and for Apple is AAPL. In daily trading, you may find an additional letter attached to the end of the stock symbol. For example, KO.N and AAPL.O, where the letters N and O stand for the exchange on which the stock is listed. The addition of N means the company is listed on the NYSE, and O means it's listed on NASDAQ. There is also a rarely used suffix letter A, which is added to the symbols of stocks listed on the Amex. Number 2, trading units for US stocks. Unlike the large trading units for Hong Kong stocks, the minimum trading unit for US stocks is 1 share. That means you can trade hundreds or thousands of shares in the US stock market, or you can trade 2 or 3 shares, depending on how much money you want to invest. As an example, let's say Amazon is currently trading at $3,000, $380 per share. Based on that price, many investors might find it too expensive to buy. But if you buy only 1 share for $3,000, $380, you can quickly earn $338 if the stock price goes up by only 10%. Of course, the inverse happens if the stock goes down by 10%, unfortunately. So do beware. Number 3, trading hours for US stocks. Unlike the trading hours of other stock markets, the trading hours for US stocks are relatively long. Theoretically, trading can go on for more than 16 hours because orders can be placed on most exchanges before the market opens as well as after the market closes. Normal trading hours for US stocks are usually between 9:30 a.m. and 4 p.m. Eastern Standard Time. These are known as intraday hours. However, with the adoption of new technologies and increased demand for trading, these hours have been extended to include so-called pre-market and after-market hours. Pre-market trading takes place between 8 a.m. and 9:30 a.m. Eastern Standard Time, but can begin as early as 4 a.m. Eastern Standard Time. Aftermarket trading begins at 4 p.m. and continues until 8 p.m. Eastern Standard Time. What's the difference, you may ask, between pre-market, aftermarket, and intraday trading? Firstly, pre-market and aftermarket trading, also known as overtime trading, refers to trading outside of normal hours. Not all brokerage firms support pre-market and aftermarket trading, but the Tiger Trade app does, and it provides pre-market and aftermarket quotations. Second, it's important to know that because of how trading works, there is no market price before the market opens or after it closes. If you place a market order before or after market hours, you can only wait until the opening for the order to be filled. Don't worry, if you don't know what a market order is right now, I'll explain it a little later on in the course. In addition to market orders not being filled, pre-market and aftermarket transactions are characterized by poor liquidity, price deviation, and prices not included in K-line chart. Because pre-market and aftermarket trading takes place outside of normal hours, the share volume is small, and so it is likely there will be a few buyers and sellers, or that the price gap between prices placed by buyers and sellers is too large to conclude a deal. In addition, sometimes pre-market or aftermarket trading prices will deviate widely from the normal price, so neither pre-market or aftermarket prices, nor opening or closing prices are included in the K-line chart. Only prices at 9:30 a.m. and 4 p.m. Eastern Standard Time are counted as opening and closing prices. Why extend the trading hours when there are so many drawbacks? Pre-market and post-market hours are very important for investors to digest all kinds of news. When official market news is about to be announced, the usual practice is to first suspend trading in the subject stock and then announce it. When the news is released, it can lead an instant sharp rise and then a sharp drop in the share price, thus damaging interests of investors. Therefore, pre-market and after-market announcements allow expected market volatility to be digested to a certain extent. A very common phenomenon is the share price rises dramatically before the opening and then immediately falls upon the opening. This is commonly known as opening high and then going low. Of course, there is also the phenomenon of a share price slumping pre-market and then opening rapidly to the upside. These are the risks of pre-market and aftermarket trading. With that in mind, let's move on to the fourth knowledge point: limits on how much stocks can rise or fall. In US stocks trading, there is no limit to pricing action. We often see certain stocks that rise more than 50% in a day. Of course, we also see stocks that fall more than 50% in a day as well. So investors, do take note. There are a lot of investors who think it's very cool to speculate in volatile US stocks. The shares of some companies can rise more than 10% a day, and it's not uncommon to see many stocks jump more than 20% during earnings season. By all means, but the usual caveat will apply. Investors need to do their homework on the companies and be aware of the potential volatility both up and down. But severe and sudden drops in markets can trigger a trading halt known as a circuit breaker. The function of the circuit breaker is to shut down trading to prevent the market from crashing and to protect investors from making unreasonable emotional trading decisions that might cause market panic. For example, in March 2020, 4 circuit breakers were triggered in the markets in the face of the continuing spread of the pandemic. It should be noted that market circuit breakers are triggered by sudden drops in the S&P 500. When the S&P 500 index falls by 7% or 13% from the previous day's close, trading will be suspended for 15 minutes, and when the index falls by 20% from the previous day's close, trading will be halted for the day. In addition to trading on an exchange being halted, individual stocks may also trigger a suspension of their trading. There are 2 kinds of trading suspensions for individual stocks: a non-regulatory mandatory suspension and a regulatory mandatory suspension. For example, if a company makes an announcement or a significant event, or if the share price rises or falls by more than 10% within 5 minutes, it may trigger a pause in the trading of that stock. This kind of pause will generally not last too long, usually a few minutes or so. The purpose of the trading halt is to give investors time to digest and absorb the news and to avoid sharp fluctuations in the price of the stock. However, the SEC imposes a regulatory suspensions of stock trading on a case-by-case basis, and so it is difficult to say how long that type of trading halt might last. Finally, let's talk about the 5th knowledge point: how long will it take for US stock redemption? This is an issue that concerns every investor. When trading US stocks, you must be familiar with 2 basic systems: the T+3 delivery system and the T+0 trading system. Number 1, T+3 delivery system. T+3 means that buyers and sellers pay money and deliver securities through a settlement system. Prior to the end of the T+3 period, you cannot withdraw cash or physical stock nor transfer custody of purchased shares. That is, the delivery of funds will be received on the 3rd working day following the trade date. This means that if you sell a position of shares, you will not have access to the proceeds of the sale for 3 trading days. Number 2, T+0 trading system. This system is used for intra-trading, that is, stocks can be bought and sold on the same day. However, the T+0 system is a double-edged sword. The quick settlement not only facilitates the closing of transactions, it also increases the risk associated with an increased ability to trade more frequently. As a result, the SEC regs state that if 4 or more intraday trades are executed within 5 trading days, or if those trades account for 6% or more of the total number of trades executed in the same period, the holder of that account will be considered a day trader. The total value of assets held in a day trading account must be more than $25,000. If the investor's trading behavior meets the definition of a day trader, but the account assets are less than $25,000, all stock trading in the account will be frozen for 90 days or until the investor's account assets reach $25,000. It should be noted that the Tiger Trade app Prime account has no capital limit and can be used to conduct unlimited ultra-day trading. Well, that's all for the 5 basics of US stock trading. Let's review today's highlights. The ticker symbol for US stocks: the trading unit for US stocks, the trading hours for US stocks, the price limit for US stocks. How long will it take for US stock redemption? Learning the 5 important knowledge points in this lesson is key to understanding how the US stock market operates. In the next lesson, I will take you through how to make good use of this knowledge for investing in US stocks. See you in the next class!